What if the retirement income that you're counting on is about to hand you a tax bill that you never saw coming? Imagine finally handing in your badge only to get a nasty surprise from the IRS. If you're stepping away from your paycheck in 2026, you absolutely need to know exactly what slice of your hard-earned money the government can touch. Because once you retire, there's no employer to automatically withhold those unexpected taxes. It's all on you, and a little foresight now can save you a world of headaches later. Hey everyone, I'm Brad Lineberger, certified financial planner who's walked thousands of pre-retirees through this exact maze. Believe me, the year you retire can be a minefield of unexpected tax liabilities if you're not prepared. Today, I'm going to break down the 5 biggest sources of taxable income that often trip people up the very year they retire. Forget the confusing jargon and that dreaded 90-page IRS pamphlet. We're just getting straight to the facts that you need. My goal? To help you keep more of what you saved because you've earned it, and Uncle Sam doesn't need to take more than his fair share. Let's jump in. Social Security, the stealth taxable benefit. Let's kick things off with a common misconception. Most people think that their Social Security benefits are completely tax-free. Wouldn't that be nice? The reality check often hits hard. If your provisional income, and we'll define that in just a moment, tops $32,000 on a joint return or $25,000 for single filers, a portion of your Social Security can indeed be taxed. And here's where it gets even more surprising. If that combined income crosses $44,000 for joint filers or $34,000 for singles, up to 85% of every monthly deposit from Social Security can be taxed at your ordinary income rates. So what exactly is provisional income? It's a key term that the IRS uses, and it includes your adjusted gross income plus any tax-exempt interest that you might have, plus half your Social Security benefits. This means things like municipal bond interest, which you might think is totally off limits to the tax man, actually counts when determining if your Social Security will be taxed. It's a classic stealth tax. Let me put it into perspective. A $3,000 Social Security check, which you might be counting on, could instantly become $2,500 after federal tax withholding if you fall into that 85% taxable bracket. And that's before you even consider state taxes. Yes, states like Colorado, Connecticut, Kansas, Minnesota, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, and West Virginia, they still grab a piece of your Social Security income, often with their own set of rules and thresholds. So that $2,500 could shrink even further depending on where you call home. Here's a pro tip that can save you from a major headache next April. You can voluntarily withhold income from each Social Security payment. The IRS offers options to withhold 7%, 10, 12, or 22% using Form W-4V. Seriously, doing this now beats getting a surprise tax bill that you weren't prepared for. Imagine the relief of not having to scramble for funds when tax season rolls around. It's a simple proactive step that can make a huge difference in managing your cash flow in retirement. Pre-tax 401k and IRA withdrawals. Next up, let's talk about those retirement accounts that you've diligently saved in for years, your traditional 401k and your IRA. While they were fantastic for tax deductions during your working years, every single dollar that you pull from these accounts in retirement is taxed at ordinary income rates. And those 2026 brackets, they just dropped, and you need to know where you stand. For single filers, you'll hit the 22% bracket once your taxable income crosses $50,400. Married couples filing jointly are going to see that 22% rate kick in at $100,800. And these aren't just abstract numbers, they directly impact your take-home pay. Let's say you need to pull $60,000 for living expenses from your traditional IRA as a single filer. You've already blown past the 12% bracket, and you're well into the 22% bracket for a significant portion of that withdrawal. This isn't just about the current year's tax bill, though. This income can also have a ripple effect, potentially bumping up your Medicare Part B and Part D premiums 2 years down the line through something called IRMA, the Income-Related Monthly Adjustment Amount. IRMA thresholds are based on your modified adjusted gross income from 2 years prior. So a large withdrawal in 2026 could mean higher Medicare premiums in 2028. For example, if your modified adjusted gross income pushes you into the second IRMA tier, you could be paying an extra $70 or more per month per person for Part B alone. That's a significant and often overlooked hidden tax on your retirement income. The key here is strategic planning. You really need to map out your withdrawals before year end. If you take a distribution and then realize it was a mistake, maybe it pushed you into a higher bracket, or maybe it triggered an IRMA surcharge, December 31st is typically the deadline to undo that distribution by rolling it back into a retirement account. Miss that date, and you're stuck with the tax consequences. Understanding your marginal tax rate and how each dollar withdrawn impacts it is crucial for smart retirement income planning. Pension and annuity payments. Pensions, for those fortunate enough to still have one, often feel like a safe, predictable income stream. And they are, but the same ordinary income rule applies here too. If you receive a pension, unless you made after-tax contributions during your working years, which is highly unlikely, every dollar of that monthly check is typically 100% taxable. Consider a common scenario. You chose a joint and 75% survivor option to ensure that your spouse receives a portion of your pension after you're gone. While this provides excellent security, it often means a slightly smaller monthly check for you during your lifetime, and that smaller check is still fully taxable. If you did make after-tax contributions, a portion of each payment is going to be considered return of your principal, making it non-taxable, while the rest is taxable interest. Your pension administrator is going to provide you with the correct taxable amount on Form 1099-R. Annuities can be a bit more complex though. If you have an annuity and it's held inside of an IRA, it functions just like any other IRA withdrawal, fully taxable as ordinary income when you take distributions. However, non-qualified annuities, meaning those purchased with after-tax money, operate on what's called the exclusion ratio. This ratio determines how much of each payment is considered a tax-free return of your original principal and how much is taxable interest. So part of each payment is your money coming back to you, and part is the earnings on that money. Only the interest portion hits your Form 1040 as taxable income. So that's why keeping Form 1099-R is handy, and it's absolutely essential for both pensions and annuities. Box 2A on the form spells out the exact taxable number that you have to report to the IRS. Don't guess and don't assume. Rely on that official document to accurately report your income and avoid any nasty surprises or potential audits. Investment gains, dividends, and interest. Now, let's dive into your investment portfolio. For 2026, long-term capital gains, that's profits from investments that you've held for at least a year and a day, continue to enjoy favorable tax rates of 0, 15, or 20%. That 0% rate is a golden opportunity, but it has limits. It stops at $50,400 for single filers and $100,800 for those who are married and filing jointly. If your other taxable income pushes you above those thresholds, your long-term capital gains rates will start getting taxed at 15% or even 20%, depending on how high your income goes. Here's a common trap. Imagine that you sell a rental property that you've owned for years, one that you've depreciated heavily over time. Not only can the capital gain from the sale push you into a higher ordinary income bracket, but you could also trigger a 25% depreciation recapture tax on all that depreciation you claim. That's a double ouch, an ordinary income hit and a separate recapture tax. It's a situation where a seemingly smart move can significantly increase your tax burden if not planned carefully. Now, qualified dividends, which come from shares of stock in U.S. corporations and certain foreign corporations, also get the same favorable long-term capital gains rates. This is a nice perk for income-generating investments. However, don't confuse them with ordinary interest. Cash, like money market yields, CDs, and even interest from your regular savings accounts are piling on as ordinary income. If your brokerage money market account is yielding close to 4%, which isn't uncommon these days, every dollar of that interest is added to your provisional income, which, as we discussed earlier, can impact how much of your Social Security benefits are taxed. It's a classic example of how different income streams interact and can stealthily increase your overall tax liability. This is also where strategies like tax loss harvesting can come into play and really help you. It can allow you to use investment losses to offset gains and potentially reduce your taxable income. Side gigs, rental, crypto, and other small income. Finally, let's talk about those small income streams that can actually have a big tax impact. Maybe you're doing some part-time consulting, or you're renting out a spare room on Airbnb on the weekends, or even just selling some crafts online. If you receive a single $600 1099K from PayPal, Etsy, or any payment processor, that income lands on Schedule C of your tax return. And here's the kicker. It faces not only income tax at your ordinary income rates, but also the full 15.3 self-employment tax, which covers Social Security and Medicare. That's a substantial bite out of what might seem like a modest income. Rental real estate, while it escapes the self-employment tax, unless you're considered a real estate professional, isn't entirely off the hook. It can still be subject to the 3.8% net investment income tax once your modified adjusted gross income tops $200,000 for single filers or $250,000 for those married filing jointly. This net investment income tax is an additional Medicare surtax on investment income for higher earners, and rental income falls squarely within its scope. And then there's cryptocurrency. Every single trade you make, buying, selling, or even exchanging one crypto for another, is a taxable event. If you hold a crypto for less than a year, it's considered short-term gains, which are taxed at your higher ordinary income rates. Hold it for more than a year, and it's a long-term capital gain, subject to the more favorable rates that we discussed earlier. The critical thing with crypto is meticulous record keeping, because the IRS is definitely paying attention. These seemingly sneaky or small income streams can have a cumulative effect. They can push your overall modified adjusted gross income higher, potentially shoving you into the IRMA tiers that we discussed earlier, making your Medicare more expensive, and also pushing you into higher tax brackets, causing you to have to pay more income tax as a result of that money. What seems like a minor side hustle could have a disproportionately large impact on your healthcare costs in retirement. It's all about understanding how these pieces fit together. Remember, the IRS rarely takes a holiday just because you do. As we've covered, Social Security can be up to 85% taxable depending on your other income. Those pre-tax accounts that you work so hard for will hit you with ordinary income rates when you withdraw. Pensions and annuities, while steady, add to that taxable pile. Even your investments can unexpectedly tip the scales, especially with depreciation recapture or money market interest rates. And don't forget those seemingly modest side hustles or crypto trades, which can crank up your income tax, your self-employment tax, the net investment income tax, and even your Medicare costs. The message is clear. You need to map out each potential source of taxable income now. By taking these proactive steps, you're going to head into 2026 confident and prepared, knowing that your hard-earned retirement money stays exactly where it belongs, with you and not Uncle Sam. And for the next one, check out how dividends are taxed. I think you're going to like it.